unlike previous ones that focused only on highs and lows, is based on swing points. Swing points are identified by three candle formations. In a swing high, the middle candle has the highest upper wick compared to the first and third candles. In a swing low, the bottom wick of the first and third candles is higher than the bottom wick of the middle candle. There are three types of swing points in advanced market structure: long-term points, intermediate-term points, and short-term points.
A candlestick chart looks so simple and familiar, but there's so much more behind it. Do you want to look deeper into the market? Let's add a heat map. Now you can see dynamic order book data directly on the chart, easily identify key
Long-term highs and lows are typically identified within daily time frames. Long-term highs are considered daily resistance levels, while long-term lows act as support. The market constantly attempts to break through these areas to establish new long-term levels. In a bullish trend on the daily time frame, the market sweeps by side liquidity by breaking long-term highs, establishing new long-term levels. Similarly, in a bearish scenario, the market sweeps sell-side liquidity, leading to the establishment of new long-term highs and lows. If the price moves against the market trend and breaks through the long-term point, it will cause a market structure break and could initiate a reversal on a higher time frame. Intermediate terms are identified in two ways. First, every time the price rebalances an old imbalance, such as a fair value gap, the corresponding swing high or low should be immediately labeled as an intermediate term high or low. The second way is when a higher swing point occurs between the first swing point and the third swing point. This higher point is identified as the intermediate term point. Only one of these conditions is sufficient for it to be designated as an intermediate point. The short-term highs and lows are the simplest form of a three-candle swing. They are formed as breakers or order blocks and do not have any special functionality. These levels are mostly broken by the market and are used only to determine intermediate points. To better understand the advanced structure of the market, we must first answer a fundamental question: what drives the market algorithm, and why do swing points form? There are two primary objectives in the market. First, liquidity hunting, and second, filling liquidity gaps. The main goal of the market is to identify and capture areas where liquidity is concentrated. High liquidity areas are typically found around support and resistance levels, key price levels, and zones where stop-loss of orders and pending orders accumulate. Long-term highs and lows can be seen as liquidity hunting, where the price breaks through previous daily support and resistance levels, creates a new long-term point, and sweeps liquidity. A liquidity gap, such as a fair value gap, is a price range where very few trades have occurred, often resulting from rapid price movements that leave behind untraded zones on the chart. These voids typically occur during news events or other significant market moves. The market will eventually move back as a swing to fill these gaps as the price seeks equilibrium. Filling these gaps restores liquidity and balance to the market, making it a potentially suitable area for entering a trade. To better understand market structure and accurately identify swing points and trading areas, we will analyze the Bitcoin chart. In the daily time frame, the price has reached a support level. Often, many traders open buy positions based on the support area, leading to a significant increase in the number of trades in that zone. As mentioned earlier, one of the goals of the market is liquidity hunting. This large candle shadow can trigger the stop losses of buyers in this area, and by sweeping up the liquidity, it forms a long-term low. The price then started a bullish movement and formed a long-term high. Now that the long-term points are clear, we'll analyze and identify the short-term and intermediate-term points on the 1-hour time frame. Based on the blue lines, the long-term points are clearly identified. Following previous definitions, we will now focus on identifying the short-term and intermediate-term points. The first swing point has encountered a fair value gap area, so it is directly defined as an intermediate high. Then, after sweeping liquidity, this happens again. The price, upon hitting a price gap, forms an intermediate term low. Then, the price continues to form several short-term points consecutively. According to previous definitions, the swing point in the middle of the two short-term points is identified as an intermediate term point. However, there's a fundamental question here. What is the difference between short-term points and intermediate-term points? As mentioned earlier, short-term points are simple swings that the market forms and subsequently breaks. In contrast, intermediate-term points are significant swings that the market reacts to. The order blocks and gaps created by intermediate-term points are more likely to impact the market, making them suitable entry areas for trades. On the other hand, short-term points are not suitable entry points for trades. Pay attention to the chart. The market has consistently moved past short-term points, breaking through them, and ultimately reacted upon reaching the price gap formed by an intermediate-term structure. But to determine if this is a suitable area to enter a trade, we need to look at the daily chart again. There's a general principle for safely entering a trade. Identify where the market started moving and in which direction it is heading. In this chart, the market has completely swept the liquidity and then started an upward move. However, it's important to note that a market structure break has not yet occurred. We can only enter a trade on this chart when the price breaks the long-term highs and then encounters a valid gap or order block in the lower time frames. Understanding market structure generally comes down to identifying swing points. The market continually creates new highs and lows, which can be categorized as short-term, intermediate-term, and long-term based on specific definitions. However, simply identifying these areas is not a sufficient reason to enter a trade. It's crucial to also predict the correct market direction. To do this, first, ensure that in the daily time frame, either buy-side or sell-side liquidity has been swept. Then, depending on your trading technique, identify the short-term point first, followed by the intermediate-term point in lower time frames. The gaps or order blocks created by the market's movement after the intermediate-term points are considered valid trading areas. There is no need for additional explanations to understand market structure properly. Test different charts and identify the swing points. This way, you can gain a complete understanding of the structure yourself. If you found the video helpful, please like and subscribe to